Bruce mentioned that he found it really easy to talk about regional updates because he really likes it, and I guess you might find it a bit strange, but I actually enjoy talking about accounting and tax matters. So happy to give you an update from that point of view. And it's an interesting area in the sense that there have been some changes in recent years, and I think what's really confused the market a little bit is a lot of these changes, some of them got implemented, some of them didn't, and it was really hard to actually for people to even know where they really stood as to what they could access from that point of view. Now, I know we have got a broad spectrum of people in the room, both from people from their family farms right through to some corporate enterprises as well. So we will touch on some topics. If not everything is relevant to you, there will certainly be something relevant to you within that, but certainly is just trying to aim to make sure there's something for everyone as well within that. I actually had this slide last year, and I've actually brought it back again simply because I think it's a really good framework to talk from in terms of, and I know it's very small, so I might fill in the data even though you can't really read it from there, and we will be seeing these slides out after as well as a bit of a presentation pack, so don't be too worried if you can't read the fine print. We'll certainly send that to you. But I guess this is a really good place to start with, and that is key thresholds. So when we're thinking about where we sit in certainly a tax landscape, we can categorise and be entitled to various concessions based on the threshold that we're sitting in. Now, within the tax system at the moment, certainly for the sorts of things that we're going to be talking about today, there are probably three key thresholds that we need to be noting. And the first of those, so I'll start with the smallest and then work to the top. The first of those are the concession thresholds which entitle you to the capital gains tax small business concessions. Okay. Now this is really relevant for those who are looking to reduce their investment in agriculture, that is if they're selling a property or selling one of a portfolio of properties, even other connected businesses to the farm, so they might actually be invested in the value chain beyond the farm, beyond farm gate as well, so that'll apply to those sorts of business assets as well. And the two thresholds there is that your turnover has to be under 2 mil, or alternatively your net assets have to be under 6 mil. Now there's a whole lot of other bits and pieces that go into that as to how you measure those thresholds, but they're the starting point as to where we go from. Now, that $2 million threshold used to be the threshold for a whole lot of other things in the past too, but has actually been taken away and increased in other areas. So the next one I wanted to talk through was what we talk about as a small business entity. Now, small business is defined in lots of different ways. In some contexts, it means businesses right up to 500 mil turnover. In other contexts, like this one, it means businesses up to 10 million turnover. Okay, so if your business is up to 10 million in turnover, and that's determined on an aggregate basis, so if you've got two entities in your group, it'll likely include both of them. Then you'll be entitled to a range of concessions for you, including the instant asset write-off. Many of you will be familiar with that, a great little saver there for assets under $20,000 at the moment. Various other depreciation concessions, prepayments you can deduct immediately, so if you pay your insurance premium for the coming year, you can deduct that immediately even though part of the premium relates to the next year, whereas people above 10 million turnover can't do that, they have to deduct it over different years. And also trading stock concessions, that is how you actually value your trading stock on hand at the end of the year and the requirements around that. So the main one really, well the two main ones within that are actually the depreciation rules and the fact that you can write off assets a whole lot quicker than other taxpayers can, and secondly the fact that you can claim prepayments immediately that apply there. So that's the $10 million threshold. Then the last one that we've got there is what we call the base rate entity threshold. And this is only applicable to companies and determines whether or not they're actually able to access the lower base rate of tax. And I'll have a whole slide about that coming up in a second. And that effectively is $25 million for the last financial year. So if your aggregate turnover is up to $25 million in the last financial year, you can access the lower company tax rate. And for this financial year that we're in now and going forward, that threshold is actually $50 million. So that's actually going to mean that a lot of companies in the private space and a lot of agricultural companies do now access that. It was proposed to keep increasing that threshold, but that part of the legislation never got up. And so we're now stuck at the moment where effectively we will have two different tax rates in the system for the indefinite future. So just talking about the company tax rate. So how many in the room actually have a company in their group? In a show of hands? Yeah, a few. And after we talk through it, some of them might be interested in having a company in your group, certainly to access some of these tax rates that are there. But the question that's been troubling people for the last number of years was, well, which rate do I get? How do I get entitled to the lower, which is what we call the base rate of tax, which is the 27.5%, compared to the 30% tax rate which other people are entitled to. And now, there were an initial introduction when those rules came in to entitle people to the lower company tax rate. You had to effectively meet a turnover threshold and just be in business. Now, the intent there was to actually be an active trading business. That's what we all thought that business meant in that common context. However, that's not what the actual meaning meant in the context of a company, and the ATO certainly confirmed this view in terms of a draft ruling that any type of activity of a company which is purposeful towards generating income would be a business. And so even if that meant having funds on investment and generating a return on that, that would be a business as well. So that wasn't the intent. They had to make a change, and now they've brought in a new concept as what we call the base rate entity and the base rate entity passive income tests. And so the new threshold now, if you want to get the 27.5% tax rate, is that you have to meet two tests. The first is that no more than 80% of your income can come from base rate passive income sources, and I'll explain what that is. And secondly, your aggregate turnover has to be under the relevant threshold, which, as I mentioned, for this year and going forward is $50 million. Okay? So that means that if you can get under that threshold and turnover, you might be in, but the second thing is then you have to make sure that the proportions of your income coming from different sources meets the test. So passive income in this context includes things like interest and rent and royalties, net capital gains and dividends, but it excludes dividends where you own more than 10% or hold more than 10% of the voting power within a company. Okay? And that's quite important. So what that means is that you might have a company that's trading, you might have a company above it which is your holding entity, and you can actually move the profits up to that holding entity which might do nothing other than own shares in the company below it and still get access to the reduced rate of tax. So they're the sorts of things that we're looking at there. So it was a grey area for one period of time as to be able to tell clients which tax rate you're even entitled to. We do now have the rules and we can give people clarity on that. But there's also a whole lot of planning and strategies that go into it, because one of the ways that this reduction in tax rate was funded was to actually limit how many franking credits you can attach when you pass a dividend from the company back to the shareholders. Okay, and so that meant there was less franking credits coming out of the company. And so we're now in a territory where we need to carefully plan how we don't waste all the franking credits. That is, if your company's been paying tax for the last many years at 30% and sometimes higher tax rate, you might still want to get the benefit of that back out to the shareholders, certainly at the 30 cents rate. You can't do it any higher. But to do that, you need to carefully plan the year in which you're going to declare those dividends so that you don't have to force to frank it at the 27.5% rate. So they're the sorts of things that we like to talk through. From an accounting point of view, a recent update in that area, this is only a very recent update actually, is that the definition of a large company, the thresholds for those have been proposed to double from the 1st of July 2019. So what this means is that if you meet two of those thresholds, or two or three of them, but if you meet at least two of them, then you'll be classified as a large company. And those thresholds currently are 25 million turnover, 12.5 million gross assets, not net assets, gross assets, or 50 employees at your balance date, which for many people is 30 June. Now, each of those thresholds are going to be doubled from the 1st of July 2019, and what that will actually mean is on estimates basis, about 30% of the companies that are now classified as large will drop out, and those companies will no longer need to lodge accounts with ASIC or need an annual audit. Okay, so that's a new threshold that's coming through. The other accounting change for those who, again, are having to prepare financial statements, especially in the corporate sense, is the new accounting standard applying to leases. So this is AASB 16 and it'll apply for financial reporting periods from the 1st of January 2019. Now, people think, oh gosh, that's too technical for me. What on earth is this? This is going too far. But let's talk about the practical effects of this. So this is an international accounting standard that's now forced upon Australia because we've adopted this accounting standard. And what it will mean is that most of the things that we think of as an operating lease, so an operating lease is when you just pay rent, typically, in that case, and you just put it through in your profit and loss as a rent expense. That's not going to be the case anymore for most of those arrangements. And what we'll actually have to do is record the asset and the liability on the balance sheet. Okay, and so it's going to grow people's balance sheets. It's also going to grow people's leverage ratios, and I think we need to start planning for this because it's coming very, very soon to determine what the impact's actually going to be. So, give you just a flavour of the sorts of implications that we can see coming is first of all, even though I've said before the thresholds are going up, I think this is going to add a whole lot more assets to people's balance sheets. And therefore they may well still need an audit. They may still go above the increased thresholds. Secondly, merger and acquisition deals are going to look entirely different. So those people looking to buy other businesses, when you go to assess it, the way that cash flows and expenses are reported in the accounts are going to look so different once this standard comes into what we're used to seeing. Bank covenants are going to be a lot harder to comply with. So if you think about that, your leverage ratio will probably go up immediately. And secondly, what used to be a rent expense will now be split between an interest expense and a depreciation. Okay, and so that's going to have an implication for determining your interest cover, how many, for those who have a ratio within their bank covenants as to how many times their profit exceeds their interest expense. That's going to rapidly change what that's going to look like. And of course, even in terms of your systems, being able to collect the data that you need to be able to report on this. So in the agri space, it can be significant because some of the property leases we have on agricultural land, if we have to start recognising those, will make a real substantial impact on what the accounts are going to look like. Okay, so that's some accounting updates. From a tax point of view, just a reminder that the immediate write-off for small business entities, the 20,000 threshold, got extended until 30 June 2019. So that is that if you are eligible for that and you go out and you buy a new item, or it doesn't have to be new in this case, can be a second-hand item for less than $20,000. Now it's less than $20,000 plus GST if you can get the GST credit. Okay, then you'll be able to, if you meet all the criteria as a small business entity, deduct that item immediately. Okay, so that rather than put it into a pool and claim it over a number of years. So that's actually been extended for the last couple of years. Whether it'll go again, I'm not too sure. The default threshold after 20 is to drop it back to 1,000. So it is a fair bit, but we've had all sorts of thresholds in the past, even 6,500 and 5,000 and so on. So we'll see where that gets to, but certainly I think it is a planning point for tax planning that we still have that threshold up until 30 June. The other point to note there is just a reminder of where we're still sitting after recent reforms on prime production assets. So we now have immediate write-off on water facilities and fencing, which has been around for a little while now. But you may have seen just in recent months, David Littleproud actually put through what we thought was a very favourable change, and that is that we now have immediate write-off for spotter storage assets as well. Okay. And so just turning to that for a moment, the immediate asset for fodder storage assets applies to assets first used or installed after on or from the 19th of August 2018. Now, fodder in this context means food for livestock such as grain, hay or silage. So if you think about that, examples could be a silo that you've got on the property. It could be bunker storage. It could be hay sheds. It could be grain sheds. All sorts of different things that you're actually using for fodder storage. But the restriction is this, and this is something that wasn't in the original law that they came in when they brought the new rules in, is that it has to be for your own, the prime producer's own livestock. When the rules came out initially, there was a lot of argy-bargy as to whether or not a grain farmer could in fact still get this for their silos, because they may be holding inventory for the neighbour next door to use within their farming operation, but unfortunately it was clarified that they couldn't get that. But even for those people who do have their own livestock, so for those cattle farmers that are there looking to do this, one opportunity that was in the rules, and we have confirmed this is the way that it will operate, is a real opportunity there in the sense of going back and looking at whether or not you can even amend prior year tax returns to make immediate claims. So the way the rules are drafted is that you claim fodder storage assets in the year that you incur the capital expenditure, okay? Even if you haven't finished the item yet. You can, if you've incurred the capital expenditure, you can claim the item in that particular year so long as it's referable to a fodder storage asset. When they said these new rules, they apply to any assets that you first use or install on or after the 19th of August. So that means, that, let's say you're building a whole silo complex and you've actually been working on that silo complex for the last period of time. Well, if you've incurred expenditure on that silo complex anywhere between the 12th of May 2015, just had to check them, and the 18th of August 2018, but you don't actually finish the works until after that date, you can actually still immediately claim all those items. So you can go back to your previous tax returns and claim that. So it's worth just looking at whether or not that applies to anyone. Now, I have to say that I think that some of the work that, a lot of the work actually that our new Federal Minister for Agriculture and Water, Mr David Littleproud, is doing is fantastic, so I'll have to say that and congratulate him on that. What I will also add though is that a lot of these announcements and the policy implementation is really missing the mark, and I find that quite disappointing. I think that, look, I'm not sure that they even realise it to some extent that they are actually missing the mark. And just to give you a little example, we just talked before about the fodder storage asset rules, which sounds great, doesn't it? But one of the restrictions there is that it has to be an asset that no one else has claimed under those rules. Okay, now if we think about, we've just gone through significant media attention on the drought. Hopefully, something comes of that, and it's not just a short period of media attention. But often the farmers that are really struggling the worst, there might be a dairy farmer, for example, that can only afford a second-hand silo. Okay, but the way the rules are drafted is they miss out on these rules, and they can't get the immediate deduction. Okay, so they're the sorts of flaws that we're seeing coming through in these provisions, and we really like to see them addressed. Another similar one is that after quite a bit of activity by Mr Littleproud, most of the banks now are actually making available the offsets for farm management deposits against the farm loans. But the practical reality is most clients are not structured in such a way that the entity that makes a farm management deposit is the same one that's got the loan. They may own the property in a trust, for example, and that's where the bank loan is. And so they can't use these offsets. And so I think, again, what we're finding is over and over again, the announcements are coming out, they say them terrific, but they're practically missing the mark when they're actually implemented. And then we're faced to give you guys the bad news as to how it does. But having said that, there's still some good news within them. We just have to be able to maximise it. Just very briefly, I will just talk through two other initiatives that are out there. The first one is fuel tax credits, and again, this is an area where we're finding a lot of clients are underclaiming, and we really would encourage people to go back and look at their claims that they are making in this area. They can certainly go back a period of time as well as with other things. So this is looking at both the types of fuel that you can claim fuel tax credits on, and the use of that fuel in which you can claim fuel tax credits on, and also making sure that we have allowed for where the ATOs sit in terms of certain concessions. So for example, even though you may have been doing this for some time, they've now confirmed the fact that you can, for example, if you've got a harvester running along the road at certain intervals, ignore that on-road use. But they've also implemented various concessions in terms of the way that you can measure the usage of fuel. Okay, because sometimes that can just be such a practical administration issue. So can I just encourage you all too to have a think about whether or not you are actually maximising the claims that are there. There's certainly your entitlement. You're paying, when you buy fuel, you're paying full price for that. You are entitled to the rebate and the offset. So please get in touch and we can actually work you through the fuel tax credit. So we actually have a team that's specialised just in this, and the sorts of claims that they've been able to help clients with is really significant. Certainly generates a lot of cash flow. The other one that you may have seen in the news is the Joint Agency Drought Task Force. So this is a recent initiative, probably following a lot of the media attention again on the drought. But the whole aim of this is to look at, well, how can the government respond better? What can it do for farmers in that area? The Coordinator General, Major General Stephen Day, he was in Warwick not so long ago talking to people, trying to get information as well. So again, if people have ideas, they're ready to listen. We don't want these things to just fall on their face and not go anywhere, but we do encourage people to give feedback to them to try to think about, well, what can we do? And look, I mean, from my point of view, I think part of the reality around drought is that we live in a country which will experience all sorts of catastrophic events, just as Craig mentioned before. It's not just drought, it can be fire, it can be flood, it can be storms, it can be hail. I was talking to some people before around the impact of hail they had on their farm only a matter of weeks ago. So the question is, how does farming survive in such a volatile nature? And the reality is it's a simple matter that you do need to be able to make enough profits in those good years to sustain the bad years, don't we? Now, if those fundamentals are not there within the agricultural industry, then we're on a hiding for nothing, trying to always patch up the problem. So we need to make sure that we do address these issues, and I think the Drought Task Force needs to face these matters very seriously, and that is, how do you operate in a very sustainable operation? Look, many cattle farmers will say they only make their profits in 3 years out of every decade, okay? And the rest of that time, they're struggling to get by. It'll depend on all sorts of factors that goes into that, but we need to make sure that those good years are really good years in such a way that the farmers can self-sustain themselves through it, because the farmers are very resilient. They will come up with their own initiatives that are there, but they do need to be able to make enough profits in the good years to do it. And some of the practical realities of that are that we operate in a business world where we have a regulated cost structure. We have to comply with Australian laws around labour rates and all sorts of things, but we're competing against an internationally subsidised market that may not necessarily have those same regulations around cost structures as well. So we need to really plan through what is the future for agriculture, how can we be competitive, what restraints do we need, what protections do we need around Australian farmers to make sure that they can make those profits, and it is a viable operation. It is viable for banks to be lending to them, it's viable for people to invest in them, it's viable for families to stay on the farm. And so again, I just really emphasise in there that we hope the Drought Task Force can take these matters seriously and look at the fundamentals that are impacting farmers. I'll just finish off with one quick slide, and that is to say, whether it's a good year or a bad year, so no matter what the harvest brings, there are certainly opportunities in terms of planning. And people often forget that. They think you just go to the accountant when you've got the good year, need to solve the tax problem. Well, in fact, it might be, unfortunately, the bad year, but that's when the turnovers are down and we can access some of those other things that we talked about on the first slide with thresholds and think about succession transactions, think about restructures, think about all sorts of things, bring farm management deposits out, all sorts of things that we can actually do. So there's plenty of planning opportunities that are there.